Hey guys, Joe Hammel with the FIRE Realty Team here. I'm working on this newsletter here, and I'm kind of getting into a blog, I guess you call it, that I'm writing. It's going to be, well, it's right here in the newsletter, why it's a great time to BRRRR. It's like, you know what, I'm going to try to capture some thoughts while I'm walking through this, because you guys might appreciate the insight. I'll do an actual analysis here, and so minimum you'll get to see an analysis deal walk through using the bigger pockets calculator on a BRRRR deal. But so let's get into it. Why is it a great time to BRRRR? Why is this urging me to talk about it? This is an interesting time in the market right now. The market's getting squeezed like crazy. Interest rates are high. It's harder than ever to get a deal that kind of pencils out, that looks good in the location that you want to buy. The good news is, as an investor, that everyone in the country is facing the same problem. Like in California, they're not having any better luck finding a deal that looks awesome on paper. And the advantage Metro Detroit has is, I do believe this is why my entire portfolio is here. Metro Detroit has the best balance of price, rent, location ratio that you're going to find. So if you think it's hard here, it's harder everywhere else. So you might as well at least focus on the best one, and then from there take the best of what's available inside that one. So I'm under contract. I closed on 2 deals last month. I'm under contract on 2 right now. All 4 of those are MLS deals. 3 out of the 4 sat on the market for a long time. One of them I grabbed in, like, I don't know, 10 days on the market. None of them are grabbed the first day or out from under anybody. But this is the exact strategy, the exact mindset I'm going to talk about here that I'm using right now. It's the exact justification or reason or way that I'm pulling the trigger on deals. And it is the BRRRR process. I'm not getting infinite ROI on any of these deals, just to be clear. Like, this is just, BRRRR is a process. You buy, I got my notes up all over the place and just talking off of them, but BRRRR is buying, it's rehabbing, refinancing, it's renting, repeat. And that's a process. You're following those steps. How well you execute it depends on how high your ROI is, but the infinite ROI of the books that were written 5, 6, 7, 10 years ago, it's a needle in a haystack. I mean, I make a small, poor joke here about, infinite ROI sounds great, but so does winning the lottery, both of which are tough, somewhat unlikely. But the BRRRR process is still incredible. If you use it and just follow it, you're still going to force sweat equity and pull out a ton of cash, and it's still going to equal higher ROI than any other way of doing it if you didn't refinance it. And we'll kind of talk through those numbers. So just get that out there. BRRRR is forced equity. You need the value of the property to increase. You can do that by fixing it up, or buying it under market value, or just naturally through appreciation. If you just wait 3-4 years, you can BRRRR. Like, you can do everything else in the step, but without a rehab. Just wait 4 years. It's going to appreciate $5,000 a year, and you can pull out that money using the BRRRR process. So, so first thing, again, just to clear the air, the highest, easiest way to maximize a BRRRR is with a cash buy, because it saves you closing costs, and in theory you'd get a discount on the property because of you're buying cash and without financing. So you're already in the hole if you're not buying cash, and you already pretty much can throw infinite ROI out the window if you're not buying cash. Again, I BRRRR most of the time financing, so it's not that financing is bad. It's just, if you're expecting the calculator to come out infinite, probably is not going to happen. So the interesting thing right now is our super high interest rates. So as soon as rates started going high and creeping up 7s, and now they're in the mid 8s, both of my deals are in the 8s. I didn't even think about it. I'm refinancing in a couple of years. I'm running my calculator at 6%, 6.5%, whatever, because I think that rates are going to get down maybe high 5s in the next couple of years. When they do, I'm going to refinance, and then I'll sit on that rate So I want my analysis to be reflective of 30 years, which will average out closer to 6.5. So I want to see that report analyzed at the 6. I'm not putting in the 8.5% in just a traditional report, because I know I'm refinancing. So then it becomes, okay, if I'm refinancing, I might as well force a little equity while I'm at it. So it maybe, instead of focusing on it perfectly turnkey, if I do have the resources, I do have the time, I do have a little bit of capital, I might as well find something that's rough and fix it up. Now I know I'm waiting for rates to come down and refinance it, and I'm making the place nicer, and a deal that would never even be close to a BRRRR before, because the margins are just tough right now. Now it's like, well, it's worth it to BRRRR because forcing a little equity, and I'm trying to get a lower rate. So that's a big reason for doing the BRRRR process right now. Another one is, I put, somewhat dangerous to me to even talk about, appreciation. I mean, we really have called the market correctly for, 3-4 years right now. Everyone screamed crash this year, and you can go back and read the newsletters. Every single month was, the data doesn't show it. And it still doesn't show it. If anything, it's the exact opposite. We're 20% down on inventory, 20% down on new listings hitting the market year over year. So August of last year, we're 15-20% down on all those numbers. Appreciation year over year, you see it in this newsletter if you read the whole thing. Where I think it's like 5% appreciation. People were talking 20% crash, and we're 5% appreciated. Anyways, the data doesn't show that we're crashing. The data, it only shows that prices are trending up. Well, if interest rates dip, what's going to happen? You might get a few extra listings because sellers can go buy with a lower interest rate, so we'll get a few more listings. But there's just droves of buyers who actually aren't even buying right now, that as soon as that rate goes down, it'll get chaotic, and it'll only put more upward pressure on the market. So you shouldn't count on appreciation, but I'm personally betting on it. I think next year and the year after that, I think I'm going to be up 5% each year. And so that's an extra 10-15 grand. If I refinance in 2 years, that's just equity. So I'm going to get a lower interest rate. I might as well fix it up a little bit. And there's a good chance that the property values are higher. All this just screams BRRRR process. So here's a quick example. I'm going to actually put this in a calculator. I just did the quick math here. This is what it could look like. You purchase something at 110. I think I ended up making this 100 just because it was a more realistic example. Purchase this at 100 grand. Interest rate 8.25 right now. It's probably what you're going to get, something like that. Rehab 15,000. I'm not talking about difficult $40,000-$50,000 BRRRR. That's for true traditional BRRRR. You're doing heavy rehabs because you're trying to get something extremely distressed and making it really, really nice. This is more mediocre fixing up. You can do this with light. You can put in 8 grand, 10 grand, pick up something that just needs paint and flooring, and still do this process. It's still going to work out pretty good. So your ARV is only 140, so you're at 100 plus 15,000, 115, ARV 140. That's not a margin that flippers or BRRRR people want to see. It's just not enough in their minds usually. So anyways, you got 40,000 invested. It's your down payment plus the rehab. $40,000 cash out of your pocket. Wait 2 years. ARV now, just through appreciation, we're up to 150 because the market, it went up, 3.5%, whatever, for 2 years. All right, interest rates are back down to 6. Awesome. So now I got an ARV of 150, interest rate of 6%, putting this thing in a calculator. This thing pops out of a cash on cash ROI of 28%. Your total cash left in the deal is $8,673. So it took $40,000. And then when you refinance this out, you got that check back, and you're only leaving $8,673 in the deal. Again, don't forget, you were cash flowing for 2 years too. So each month you were cash flowing $300 a month, whatever that is. I think that's what it came out to when I put it in. That's $5,000 back just in cash flow paying you back. So it ends up being, you got 3K in this deal right here. And that's just your cash on cash. Cash on cash is only based on that cash flow. You still have, after this, another 5K a year in appreciation. And you're making nearly, the math comes out to almost $2,000 a year in principal pay down. That's a $7,000 a year equity gain. And then again, investing, there's no better in income for tax advantages. So you're getting taxed way less than any other type of income. And the best part is it's just not that, this just isn't that hard. Normally, BRRRR investing is hard. It's a high on the difficulty scale because you got to find a needle in a haystack and you got to execute it very well on a difficult project. This one's not. Like, I'm not telling you to go do a $30,000-$40,000 rehab. Pick up the lighter sweat equity stuff. Still, it's not easy. I mean, you still got to manage contractors. You still got to find something and make it happen. It still takes some level of competence and execution, but it's not a 9 out of 10 or a 10 out of 10 on the difficulty scale. This is just, these are all over the place. It's why, and I get into it down here a little bit. When I have the money and green light to go buy a property, usually takes me under a week to put something under contract. It's because I have the same process every time. I'm not looking for what is the best property of the decade. Like, I'm not looking for ROI that matches what I was getting or seeing in 2020, 2019. All I'm doing is there's 17,000 houses on the market, and if you rank those, okay, what's the best deal on the market right now? $17,000 house, 17,000 houses. You have to buy one. Which one's the best one? Okay, you rank it all the way through to the last one is 17,000, 19,000s. That's the worst deal. You don't want to touch that one. Well, all I'm doing is looking at the top 1%. So, you've got 100, 200 properties to kind of pick from, pick your market. I go out, I pick 10, go do a couple showings. I pick the top 2, 3. I'm like, all right, I looked at the market. I'm not really seeing anything better than these couple. Yeah, I would like to see a little bit better, but I'm ready to buy now. And writing offers, and whichever one I get, do my inspection. As long as it looks good, I'm closing. I'm moving forward. That's the way you continue to move forward in an ever-changing market. You're not going to compare numbers to 2010 buy and be happy. So simplify it. Just pick the best of what's out there right now. The top 1%. You're looking for the top 1% of deals. If you do that your entire career, you always are picking the top 1%. In 2 or 3 years, that top 1% might be better, it might be worse than what you're buying right now. But that's buying consistently over time, and it'll average out. It's probably one of the best pieces of advice, aside from just pulling the trigger and getting started, because you learn so much, is pick the top 1% of what's available right now. Let's do it real quick. So make sure I didn't miss anything. So let's just put one in a starting report. For example, whatever, property taxes, 2,200. You can find that. I don't know, maybe a little bit optimistic these days. Buy it for $100,000. My ARV right now, if I fix this up, 140. And you'll see what I do later when I actually refinance in 2 years. Purchase closing costs, 5,500. Sometimes you see higher points are kind of outrageous right now. Sometimes you're paying escrow taxes and insurance, so it's arguable in terms of, is that a cost or is that insurance and taxes money? Whatever, 5,500. Estimated repair costs, 15,000. Down payment, we're putting 20% down. Interest rate, 8.25. I think that's what I've been kind of using, 8.25, 8.5. Amortize over 30. I'm doing that because I'm going to refinance this. If I was doing this as a long term, just buy and hold, I'd put in my 6.5 or 6 because I want to see what that looks like in 10 years. I don't care about year one that much. So I'm going to refinance this after 24 months. Okay. My rehab time, say 4 months. You're doing pretty good. Loan amount. So now remember what I said. In 2 years, this thing's going to be worth 150,000. So I'm going to take 75% of the $150,000 number. That's 112,500. Loan interest rate, 6. A little bit optimistic. I mean, you can say 6.25 because say you get a high 5s. I'm sorry. Let's say you refinance it at 6.25. I don't know. Could do 6. Be tempting. If in 2 years it hits 6.25, I'm probably just gonna pull the trigger. Amortize over 30 years. Put them on. It's a 3-1. I'm getting $14.50. I'm putting $50 in for pet rent. Again, that number's gonna move. Insurance, whatever, $75. Close vacancy. I'm just going pies across the board here. I'll put in a 10. I personally self-manage, so I don't have this expense, but I don't know, 60, 70% of you guys, 60% of you guys do, I'd say. Income growth, 3. Sales expense, for you guys, it's going to be 8. Calculate results. Bam. Okay. So somehow this is a little bit better than even the one I was looking at. It's total cash needed. You need $40,500 to do this deal. Once you refinance it, almost 200 a month cash flow. Usually BRRRRs don't cash flow. Think about that because you're putting on this big mortgage. So now your mortgage is much higher. So that's the thing. If you're going 100% all cash flow, BRRRR might not be the best strategy because you're really chopping down cash flow versus see it's $100 higher in the initial period. But again, 8%. So if this was just a buy and hold fix up, most you guys would turn up your nose. You'd be like 8%. Oh, I want 10. I want 10, 12. So you'd pass this over, but you do this strategy, 32% cash on cash. It's a green light for me. If I see this deal, I'm pulling the trigger, I'm doing it, and I'm moving on. I mean, as long as I like the other factors, location, stuff like that. I mean, look at that number, 244% cash on cash ROI eventually. Just year 3, you sold this thing. I mean, it's just, you just can't beat it. Anyways, that's what I'm doing right now. I'm doing soft BRRRRs, realistic BRRRRs, whatever you want to call them. Probably make a couple edits to this, and you guys will see it in the newsletter. Hopefully you guys like this. Maybe we'll do more of it. See ya.